Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The US Federal Reserve, America's central bank, has raised interest rates by 0.25%. Now, that raise may seem small, but this is the first time in 7 years that the Federal Reserve has raised rates. The hike has been keenly anticipated and awaited by world markets because a rate hike in the US can potentially draw capital and funds back into America, among other impact. Now, this also ends a near zero interest rate era and reflects the confidence that the US economy is becoming stronger. Now, what does this mean for Indian markets and capital flows? Now, while Indian markets have shown resilience so far, what if there are further hikes as is being anticipated? What is the outlook for Indian financial markets for 2016 on the back of this hike? Joining me to discuss this are Vineet Bhatnagar, Managing Director of Phillip Capital, Andrew Holland, CEO of Ambit Investment Advisors, and Bansi, Madhavani, Analyst at India Ratings. Thank you all for joining me. So let me begin with you, Andrew. So this has been priced in. The Indian markets didn't really react. They actually looked up. The government has released a statement saying that everything is fine. Is it so?
I think so. I mean, looking, actually kind of analysing what she's done, she's going to put a put option there for us. Because what she's saying is that, if the data in the US is strong, if globally it's strong, then I'm going to raise interest rates. So that's great news, right? We're going to have a strong global economy. That will be good for emerging markets. If the data's not so good or the global economy is kind of struggling, she's not going to raise rates. But she's kept the balance sheet of the Fed very, very bloated, which means that liquidity is going to be there. So I think it's saying whichever way we look at it, we should be positive because it's going to, as interest rates move up, it's really that you're going to see a strong global economy. That's good for emerging markets.
Right. Okay. So, Vineet, if you were to look at it from an India point of view, we've anticipated it, priced it in, and seem to be now coasting somewhat smoothly. Is that a fair assessment?
Yeah, I think so. I think it was priced in quite well, soon after the September nervousness that we saw. So from October, November onwards, everybody was expecting this. So it was in line with the anticipated move by the Fed. The markets, at least as far as India is concerned, should be driven by domestic cues, unless, of course, all that we are anticipating in terms of the normalization process for Fed in 2016 and 2017 is slower than what we all believe is the strength of the underlying US economy.
Let me take a step back and let me ask you a more generic question for our viewers. Why should we be so concerned about what the Fed is doing?
I think we should be concerned about what Fed is doing primarily because US markets and the US investors are one of the biggest investors in terms of the capital inflows into all emerging markets, including India. And we also understand that the sensitivity of the index performance in markets like India is so much correlated positively to the inflows. So from that perspective, what Fed does, which is a bellwether for where the larger world economies are moving, is always important for Raghuram as much as it is for Yellen.
Right. Okay. So if I were to look at the Indian markets, how they've performed and are likely to perform versus other emerging markets who are the recipient of flows from America, how would you say that's going to pan out or likely to pan out?
So I think if flows come back to emerging markets, then India will get its fair share. But I don't think it's going to be, everyone's going to rush to India. The story's well known, and our valuations are reasonably kind of high, if kind of reasonably valued at the moment. So if you compare it with other emerging markets where there's value, you could see incremental money going more towards other emerging markets before India. We have really nothing domestically to kind of push us higher. There's no real catalyst. I mean, the reform process is we're going nowhere, basically. So there's, unless earnings start to pick up very quickly, which it doesn't look as though it's likely, then there's no real catalyst for everyone to rush to India. Everyone loves the story for India, and they don't want to sell out of it, but I think there's better opportunities. There's better opportunities and valuations in other emerging markets at the moment.
Okay, so Bansi, if you were to look at the Fed rate hike, now we on the other hand are reducing interest rates and the expectations are that we should reduce it further. How should one as a lay observer look at this phenomenon, versus what's happening in America or maybe might happen in Europe as well and versus what's happening in India?
In fact, that divergent policy is the theme which is playing out across US and the advanced economies as well as on the EM front as well. I think one way to look at it is the fact that a lot of EMs are undergoing a structural reform right now. From 2013 to right now, India also has seen a lot of, some of them were band-aid measures, some of them were genuinely reform measures which are undergoing. From here on, the divergence in policy is something that will critically, keep the market nerves on the tenterhooks. But one would assess that that theme is not something which will make the markets much more jittery. So our reading is that the rate hikes by Fed is going to be more gradual. The rate cuts by EMs are going to be much more gradual. So to that extent, you're not going to see a lot of push and pull to that, on the market front.
Okay, and that you feel playing out in most of 2016, if not?
Yes. I think 2016 is likely to be, not too much of a central bank driven market that it was in 2015.
Okay, that's an interesting point. So Vineet, let me come back to you. What's your house view if you were to look at 2016 from a flows and investment point of view?
So our house view is that 2016 could turn out to be a turnaround year for India as well as for a lot of economies such as Central Europe and even US as a validation of what we are looking at right now. And 2017 onwards could be the year where the growth story will take the center play. Our house view is that post June 2016 onwards, there should be corporate earnings perking up as far as Indian corporates are concerned.
Right. So is earnings a critical driver or trigger that the markets would wait for? And therefore, is there anything else that we should be looking?
No, I think that is very important. As Andrew was also saying that, having understood as to what New Delhi can, implement, propose, and is able to push through. Regardless of that, if the corporate earnings were to come back, then they do occupy the centerpiece as far as market sentiments are concerned and also the inflows.
Right. So you did mention about domestic investors and that being a strong point, and to some extent that's been the reason why Indian markets have not fallen when foreign investors have exited. What's the sense for 2016? Do you see that continuing?
I think in many ways the last 4 or 5 months have been a bit of a wake-up call in terms of how we have looked at the retail India participating in the equities market till now. So there is a general assessment that the India retail runs away very quickly and shies away from investments whenever there are volatilities or nervousness around the markets. But the experience through the SIP route that one has seen in the Indian mutual funds, and also some constant good performance and asset gathering by the local PMS in India is supportive of the fact that there is some coming of age for Indian domestic individual investors, and that's very heartening. If that were to continue even in 2016, I would imagine that the DIIs and the direct equity investments by India retail should remain smart and healthy.
Right. So okay, let me ask you about what are the kind of policy expectations that you have in order to keep keep all of this going and the pot stirring, so to speak. Andrew, let me begin with you.
Before I mention it, I'm just on the SIPs because it's an important point. Every month now, nearly 4,000 crores comes through SIPs. That's not going to go away.
Right.
That's only going to build over the next few years. So, foreign investors are going to become less important, I think, going forward. It's going to be a help kind of move the markets higher if they become net buyers. On the policy front, I think expectations are so low now. The GST, whatever form GST comes in.
Or if it's off the table, then what?
It was never a big, to my mind, it was more of a sentiment positive rather than it's going to boost GDP straight away. If they spend more money on the railways than they are doing in expenditure, that's going to have a much bigger impact on GDP. Probably more like 2% GDP growth can come just from railway spending. GST, I don't think anyone's ever talked about 2% GDP growth.
Right.
So, I'd rather see that's where I would rather see the government spend their
Okay, so the one big policy thing that you would be looking out for is really to say, let's keep the spending up, as many others have been saying, and even if we don't get GST in the next 6 months, 1 year, that's fine.
It's not going to move.
It's not a game changer, at least from the market's point of view. Vineet?
Yes, I absolutely agree. In fact, one of the themes to play out for 2016 is the commitment that the government has shown in terms of public spending, notwithstanding the 7th pay commission related fiscal impact that we are all happy to live with, as long as the public investments and public spending remains. Sectors like infrastructure, road, railways are really going to be the key.
Okay, and is there anything from a policy point of view that you are specifically looking out for? I mean, for instance, some people have been talking about, let's say, a sharper management of the banking problem or the banking stress problem. There could be other issues to do with, let's say, managing the fisc.
Managing the fisc, I think the intent in terms of following the broader framework of FRBM has been repeatedly mentioned by all finance ministers in the last 5 years or so, and the present finance minister has also shown his commitment to continue to be disciplined about it. I think that will get reiterated even in the union budget in February. But notwithstanding that, if there is any slippage, as we are expecting, through the due to seventh pay commission, it is all right, as long as the public spending is not the one that will be compromised to attain a 3.5% fiscal deficit. So one is not saying that we are only fixated by the percentages and the numbers. The overall approach to kickstart the economy and the capex cycle is far more important, and that is where all eyes are.
Okay, right. So, Bansi, what's your sense for 2016? I mean, we did talk about interest rates, where you're saying that not much is likely to happen.
Right.
Any other broader economy?
I think one of the interesting parts that we would be watching out for, how the markets take back the entire point of, I was mentioning that central banks is no longer a trade. It's not a trade now. Now it's the fundamentals which will start driving your both the equities, and on the interest rate front also we are seeing a lot of macroeconomic fundamentals driving the rates market. So I think one theme that we are particularly looking at is how the asset linkages play out over this period of 2016 across economies as well, and across inter-asset classes also. So less of central bank. Let's say I'm looking at how the US markets are performing vis-a-vis the Indian markets, and even on the Indian markets front, let's say what's the relation between rupee and bonds that we are going to see in the coming year. So I mean, those are some of the key points that we are kind of watching out, because the central bank seems to have taken a back seat for now.
Okay, and the rupee itself, do you have a view on that?
Well, we had highlighted that rupee in the near term is bound to have something positive in store. So we've been saying that when the currency was at 67 plus, what we are seeing is that you started off by mentioning that Fed is well under the bridge now, and what next? The idea was that there was a lot of fear of Fed which was built in, more than the Fed rate hike per se. So that being taken care of, one would think that there's some positive in store. But obviously, as fundamentals do shape up and you move towards a divergence cycle, a longer term depreciation is inevitable for currency.
Right. Okay. So Vineet, what's going to do well in 2016?
In terms of the sectors?
Yeah.
So we were looking at road, railways. We are looking at even sectors which are important for the overall policy point of view, such as affordable housing. We are still positive about urban discretionary spend on the back of a recovery that is still divergent between the urban and the rural divide, as we have seen in 2015. That may amplify by the time we reach June 2016. So those are the sectors that we are looking at. There are very small, narrow segments that are expected to do well, within pharmaceuticals, such as specialty chemicals, on the back of a strong dollar, which perhaps will be the theme for the next few quarters. Export-related sectors can be played, sensibly.
Right. So I mean, and the undertone seems to be fairly bullish, from what I can take away from this.
Yes.
Right. Okay. So would you concur?
Yes. You see, India is a domestic growth story. I mean, you can talk about exports, but it's really India is a domestic growth story. So we look for, our theme has been for the past year, will continue for the next few years, is who supplies India. So if you're going to spend money on railways, someone's got to supply the track, the carriages. So India is all about operational gearing. So it's more the manufacturing side that we think will see the big earnings growth going forward. So that's what's going to be the driver of operational gearing. Financial gearing will be the driver of earnings in 2016, and that's what will push the markets higher.
Right, and that's a good note to end on. Thank you so much all for joining me. We need to take a break here, but coming up on the other side, there are macroeconomic numbers that have been emerging. Let's try and understand that and link it back to some of those Fed rate discussions that we've been having. Stay with us. Welcome back to Policy Watch. This was a week of numbers. While the US Fed hiked interest rates in America and India, we saw a 5-year high in industrial production. We also saw inflation numbers rise. What are the cues that we can take from these domestic and international numbers, and to what extent can we see continuing trends for 2016, and what is the broader outlook, both opportunity and challenges? To discuss all of this are DK Joshi, Chief Economist of CRISIL, and A. Prasanna, Chief Economist at ICICI Securities. We've had a series of numbers emerging, and let's try and connect what's happened with all those numbers that we've seen, mainly index of industrial production, wholesale price index, and to some of the other developments which are external, like the Fed rate hike, and finally, what does the outlook look like? So let's begin with the index of industrial production, which was a 5-year high.
Well, I think you need to take it with a pinch of salt, because if you look at what happened last year, it actually shrank. And if you look at particularly consumer goods, last year there was a degrowth of over minus 40%. So it's, even if it grows 42% over minus 40%, it's hardly
as durables did.
Durables did. It's hardly a movement. I mean, so it's a very. I think what I agree with is that industry is gradually recovering, but the 9.8% clearly overstates, and I think this is not the kind of growth we'll see in the next couple of months.
Okay, Prasanna, can I get you in quickly? We're trying to see what is the linkage between some of the larger numbers that we've seen and the state of the economy as a whole before we try and come to an outlook, because we are reaching the end of the year.
Yeah, so industrial growth, clearly there was a base effect at play, right? Because of the whole festive season, I think the dates keep shifting. So I think it's better to take October and November together and see the average growth over those 2 months. So obviously we have to wait for November data. So that will give you a better sense of what is the actual underlying growth. But on a standalone basis, clearly the October number was an aberration.
The other number that came in, which is the consumer price inflation and the wholesale price inflation. So wholesale price inflation has gone up slightly, but consumer price inflation seems to be worrying.
Well, I think it's worrying in the sense, but in the sense that it's moving up, but part of it is again, I think, base effect. I mean, in the sense it's very good base effect is wearing off, so we'll see inflation inching up. But the good news on the inflation front is that the oil prices, commodity prices are still depressed. So and they're going to play out like in a depressed manner next year as well. The food inflation is generally under control, except for patches of pulses, etc. I think the other food items are broadly under control right now. So there is no generalized pressure on inflation at this juncture, and the central bank's target of 6% by January 2016, I think, is very much it will be met.
So, I mean, let's focus on the worrying part. Pulses may be one example. What about the numbers show you our ability to control something and our ability not to control, i.e. we are benefiting because there is either a global sort of depression of prices or some other factor external?
Well, I think there's a significant contribution from good luck, I mean, which is the global oil and global commodity prices. Even agri commodity prices for many of the items have been quite subdued for quite some time. So there's a big element of good luck here. But I think you should also remember here that we had 2 consecutive years of bad monsoon, and even with that, food inflation is generally under control. So there is some effort that has been made by the government, whether it is restraint in minimum support price increase or it is being more proactive with the food stocks. I think all those things have helped. But the issue is that if you want this to continue, I think you need a good dose of monsoons, good luck next year from the monsoons. Otherwise, I think the food inflation, you will run out of stocks eventually. So the pressure will start building there.
Right. So Prasanna, before we come to the outlook, so to what extent are we running on accident and to what extent design in the numbers that we're seeing around us, or if I were to extend that question, in some of our macroeconomic fundamentals?
Yeah, so if you look at inflation again, I think if you kind of segregate into goods and services, I think clearly there's a lot of good luck on the goods front, right? It's mainly because of global commodity prices, and that's why your WPI is actually in negative territory for quite some time. And some of it has kind of transmitted itself to CPI also. But if you look at services component per se, and that is largely in the CPI basket, I mean WPI doesn't have services. So that inflation is still running pretty high. I think if you segregate within core inflation, our estimate is services inflation will be running close to 6%. So which means that, of course, that has also come off quite gradually over the last 1 year. And there I think what the RBI is trying to do in terms of having an inflation target and communicating about that and trying to gain credibility that they're focused on inflation, I think that will start paying some dividends over a period of time. But I think that battle is yet to be won. So by and large now, I think a lot of the gains on inflation have come from external factors. Of course, on food management, I think at least on cereals, there's been better management. There's no doubt about that. But again, like you mentioned, pulses as inflation has become a worrying problem. And if you look at it, this year there's been a spike in pulses. But even in the previous years, if you look at it, pulses inflation has always been at elevated levels. And this year the problem became acute. But this is more of a structural problem which got worsened because of monsoon failure. So some of these longer term problems are yet to be addressed. And I guess going forward, perhaps if some of the luck turns on the global side, maybe these problems have to be addressed. Otherwise, the worries could start mounting.
Okay, so DK, so that's the concern, and perhaps as we look ahead, to what extent are we equipped to handle some of the challenges that 2016 will throw at us in the economic side, and to what extent is our outlook in a way, anticipating some of these problems, and to what extent are we confident about things the way they will pan out?
Well, I think next year's outlook critically hinges on what happens to monsoons, because we've been talking about base effects. Agriculture has hardly grown in the last 2 years. So if you get a good dose of monsoon, normal monsoon, agriculture is going to shoot up above trend. So that is going to optically raise GDP. So I think monsoon is very critical. The second part is the private consumption, and where I think bring in private consumption here, is that the private consumption is moving on one leg right now, the urban leg. The rural leg is limping, because of the rural. So I think that will also get a boost from the monsoons. So I think once the consumption starts lifting, then I think you can hope that capacity utilization will start improving, and then maybe the private sector might start getting interested in investing. Now, if this is a big risk.
But you're saying that a lot of this is going to hinge on monsoons once again?
Yeah, it is hinging. Because what else is the driver? The global demand is very weak. Exports are negative this year, so they might look positive, but still, I think global demand is not going to help you. Now, and on the side of demand creation in the economy by policy, we know the limits. I think the monetary and fiscal policy both are constrained as far as that is concerned. So the growth revival is very gradual, and I think the monsoon will be it's like oil. From the heaven. You can't influence it, but it has a beneficial impact on you. So if that happens, then the recovery in consumption will be slightly faster, and maybe the private investment will also return slightly quicker. We expect private corporate investment to return by the end of 2016-17. So it is. I think there's a long time for private sector to come in. Now, so that is one. Second is on the Fed side. I think we've managed this risk pretty well as far as the initial thing is concerned. But what we also should know that
because the market's already priced it.
The policy is going to diverge in Europe, in Japan, in China. These big economies are going to cut rates, and US is going to raise. So there could be some volatility over time associated with that. We don't know how that plays out. Then China slowing down. Now, China I want to bring in is because China slowing down, it looked like a gain for us, but it's not actually. Our trade deficit with China has bloated. What we export to China is raw materials.
We import lots of mobile phones.
Phones and other consumption items which are very, very sticky. So slowdown of China is actually bad news for us, and it also is hurting our exports to other economies which are closely linked to China. So it's not an opportunity in that sense. So I think there is a lot to watch out for, and I would see the risk from the monsoon from an internal side as the biggest risk, I think, for next year.
Okay, and the external side, you're saying it's really global economies, particularly China, who we thought was a plus because we would have benefited from this slowdown, which we are not.
But I think the other are geopolitical risks which actually have been rising over time. And then finally, I think the oil being low is a good news for us, but could be a bad news if it continues to be too low, because many of the Middle Eastern countries are running high fiscal deficit. I think Saudi Arabia, for instance, the fiscal deficit has risen above 22%. Right. So the ability to support Indian workers and remittances to India it could be challenged.
Okay, that's an interesting point, and I'm going to come back to you for the wrap on that. Prasanna, what's your outlook if I were to ask you to quickly sum up?
So so basically I think the economy is just running on two engines, which is private consumption and government spending on capex. Again, I think in private consumption it's more of urban consumption, of course. So this we don't think it's going to change much into next year. Now, one area of hope is, of course, exports. Exports got pretty badly affected globally this year. So we are cautious that next year there will be some improvement. Incrementally, there could be some improvement. First of all, if commodity prices do stabilize even at current levels, then in nominal terms, clearly there will be some pickup. And of course, as the US Fed hikes rates in a gradual manner, and the ECB is also trying to stimulate the European economy, we do hope that the global outlook doesn't worsen from here. At least in the second half of this year, I think there were a lot of alarms. So hopefully some of those problems are behind us. Even in case of China, for example, I think now it is well accepted by markets that China is slowing down. And as long as the Chinese government is able to manage it in a very controlled manner, so we are cautiously optimistic that next year global growth, even if it doesn't pick up much from this year, at least it will be less volatile in terms of the outlook and in terms of expectations. Which means that we are again cautiously optimistic on exports. But otherwise, as far as the private investment is concerned, I think we are not so sanguine that even by the end of next year it will start picking up. I think there are a couple of reasons for that. One is, I think, clearly parts of private sector, I think the balance sheets are impaired, particularly areas which require heavy investment in, say, the infrastructure industries. Also, I think the other bigger problem for India is, I think, the banking system. I think the balance sheet problems in the banks are not behind us. I think it's going to take another 1.5 years perhaps to completely fix those problems. That being the case, I think the capex cycle, I think it's going to take quite some time before it can start kicking off, because both from the demand for borrowing as well as the providers of the lenders, I think both the balance sheets are impaired, and therefore they're going to take their own time to before they embark on a fresh round of capex cycle. So which means that again we are looking at the lenders. I think both the balance sheets are impaired, and therefore they're going to take their own time to before they embark on a fresh round of capex cycle. So which means that again we are looking at only consumption and government spending to support the economy with some expectation, with a cautious expectation that exports could start picking up.
Right. Thanks for that, Prasanna. So last word, what is the one thing that you're positively looking ahead for and one thing that you're concerned about?
Well, I think I have concerns on the monsoon front because of the global weather situation, and there are some risks on the El Nino being pointed out. So I think that think is a big risk.
And you've already added that that's going to be the key trigger that you're at least watching out for the whole economy.
From the internal triggers. I think the positive side is that some of the things that RBI did in terms of cutting rates will be felt next year because the monetary policy impacts with a lag. So some of that positive will be visible in the coming.
And government spending, thanks, and also to 7th Pay Commission, we'll see
I think
money coming into the system.
These will help support consumption. But I think the point is that it's a grind up. I mean, it's not a quick lift in the economy. There's no steroid to pump it up. So it is very, very gradual.
So don't expect too much in 2016. I think is
even if growth goes to 8%, which we are expecting, I think that will be largely on the kick from agriculture and monsoons normalizing.
Okay, right. We've run out of time. Thank you so much, DK, and thank you, Prasanna. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.